Hello and welcome to Econoday Unplugged on Tuesday, the 14th of January 2020. Mark Pender is across the pond stateside, and I'm Jeremy Hawkins here in London. Well, phase one of US-China trade deal is expected to be signed tomorrow. That's Wednesday. And sentiment on this front has been further bolstered by the White House apparently removing China from its official list of currency manipulators. So that's all good news, and stock markets are very happy about it. But it's not all good because the European Union this week will resume its efforts to prevent a EU-US trade war. And while Middle Eastern tensions have eased in recent days, Iran's decision to suspend all limits on its production of enriched uranium means that potential political troubles in that part of the world are far from sorted. So geopolitics should clearly remain a key focus for investors. And of course, in terms of key focuses for investors, US employment comes very much into the focal point. And Mr. Pender.
Yes.
December, a smaller than expected payroll gain, annual wage growth sliding below 3%. And if I remember rightly, a shorter working week as well. Should we be worried?
Worried. But the unemployment rate stayed low at 3.5%. So if the worry would be that there's a slack developing in the employment and the labor market, it's not completely evident. You would expect the unemployment rate to rise, but it's holding at 50-year lows. The change in non-farm payrolls was 145,000 rise, which is a perfectly respectable rate. Just by comparison, though, it's more than 100,000 below the prior month, and it was a little bit below the average for the year. It also reflected in part 12,000 swing lower for manufacturing payrolls, which have been bouncing around after the GM strike. But really the key is average hourly earnings. Now, is that something to worry about? Well, it's very flat. Maybe if you're, in the labor force, it would be something to worry about. But if you're at the corporate headquarters, maybe that's a good sign. You're going to have higher profits. The 2.9% year-on-year change was very weak. And this series is pointing lower. It's trending down. And the monthly rise gain was only 0.1%. These were all below Econoday's consensus range. So it took people by surprise. And we had the CPI today with the core rate also at only 0.1 monthly increase. And if you do a little bit, you can just right off the cuff, the year-on-year rate for the CPI was 2.3%. Average hourly earnings are 2.9%. So we're talking about a 0.5% type of annual increase in real wages, which is not very strong. Is that going to increase? It's especially not very strong, given how low the unemployment rate is, how much demand there is for labor. Whatever is happening, labor hasn't been able to get any power, any friction, any ability to increase the wages. So this is very much a corporate profit. Positive for corporate profits, and if you're in the stock market, it has to be, you would think, a plus. Even though you were saying where there are some signs that maybe the economy's slow. A little bit at year-end, factory orders were weak, and that is a possibility. And that, a little bit of lack of momentum going into the new year. But like you're saying, the geopolitical. It is mixed, but the trade agreement is a very strong positive. We've immediately seen improvement in the U.S. trade picture with strong gains for food exports, a lower deficit with China. So that should be a positive. Fourth quarter GDP could prove very strong, depending on retail sales. We'll get retail sales on Thursday. That will show us really how the consumer spending did, which will be a vital statistic here. But if that just goes normal, then as expected, a solid, moderate to solid expectations for holiday spending right now. We could have a very strong fourth quarter GDP showing.
Okay, let's try taking a different tack on this then. So we're saying that wages are going down, employment's going up. So it suggests that new employees are being paid quite a lot less, or indeed we're getting some wage cuts in some part of the world, or some part of the economy, I should say. So how about the view then, if wages are really sort of semi-stagnating, at least in parts of the economy, that's got to be bad news for overall income growth, which is bad news for consumer spending, which is bad news for sales, which is bad news for corporate profits. Should companies be paying their workers more?
Well, I don't know what this goes back, if you want to talk politics. I mean, this goes back to Ronald Reagan and the flight controllers issues. He broke that strike, and labor has kind of never really been the same since that. And the law of the land favors the corporate boards, favors the financial markets, financialization, but that has been a long trend, and it's been a trend where there's been a consensus in America that this is good. And part of maybe what we're seeing is that the other side of this is, flat, if not, stagnant wage growth over a long period of time, where we've had a lot of productivity improvements. We've had the web. We've had this gigantic burst of computerization. And this hasn't helped people's productivity. This hasn't helped increase wages. We work longer and for no better wages. Anyway, but so that these are kind of serious issues, but they're stuck in this long term, and it's fixed by the legal system over the years. It would take a very big breakthrough, some kind of it would have to be something probably unfortunate, like a recession or something like that, to pull this out or to change this momentum at all. It looks like this is what is set for right now, and you can say that the productivity of the American worker is down, and that's why we have low wages. I don't know. I disagree with that. I think that the people I'm around, our productivity is so much higher than it was, and it grows every year. If nothing else, because of technology. Now you got me rambling on. So
okay.
Tell me your view.
Interesting stuff. Well, a view from Europe certainly is one of, I suppose, depressed productivity growth rates, particularly as far as the UK is concerned anyway. I mean, ours is currently running, about an average 0.3% a year over the last decade or so. One reason for that, of course, is the weakness of manufacturing. And as far as Europe's concerned, this week will be another period for the IP figures. And they're, I suppose, becoming increasingly important in the sense that there has been this little bit of, I suppose, optimism within Europe, at least a reduced sense of a pessimism as we approach the end of last year, that perhaps the worst was over and 2020 could prove to be a rather stronger European economy than originally expected. But that has been in large part predicated upon some kind of turnaround within manufacturing. So what happens this week will at least have some bearing on that. Now, in regards to that, we'll get the industrial production figures for November out of the Eurozone. They're due on Wednesday, expected to show a small increase of about 0.3%. And that'll be driven by Germany, which is still marred in recession for manufacturing, but output there was actually up 1.1% on the month for the mid-quarter reading. So that's going to help to lead that. But although I guess, really for the fourth quarter, Eurozone manufacturing is going to struggle still to avoid remaining in recession, the hopes are going to be from the more forward-looking indicators that they're realised in terms of higher growth once we get into the first quarter. And regards to that, I suppose the most important two figures we've had out as far as the ECB is concerned since we last spoke, the final December composite PMI, particularly for manufacturing, and also the economic sentiment index released from the European Commission. They both offered hope that, well, hey, perhaps this European economy is actually starting to bottom now, and there could be slightly better things ahead. Early days yet, but it's something which obviously the ECB will be watching very closely because their first meeting of the year is next week. In terms of terrible numbers, though, and I suppose we talked a lot about central banks running out of room in a lot of countries to reduce interest rates. The UK has a little bit of scope, and although no one's been talking about any kind of shift in UK interest rates for a long time now, we had a succession of pretty dovish comments coming out last week from at least three MPC members, including the Bank of England Governor Mark Carney, who'll be holding, or I should say, attending his last MPC meeting during his governorship at the end of this month. They're all talking about downside risks, and all of a sudden this idea that, well, look, now we know kind of what's going to happen to Brexit, at least we know we're leaving, and we've got the general election out the way, and we've got a Conservative government with a huge majority, legislation can go through as they want. That might give a bit of a bounce to business confidence and consumer confidence. Well, it's going to be needed because the November industrial production figures for the UK were horrible. Total IP was down 1.2% on the month. The key manufacturing sector contracted by 1.7%. And what does that mean? Well, it means if we don't get any revisions, December will need to see a monthly increase of at least 2.2%, which is hugely unlikely. Or we're going to see a contraction in fourth quarter industrial production. And that could very much lead to a contraction in the economy as a whole, because we also had November, the monthly GDP figures, which were down 0.3% month on month. And that's the worst aggregate performance we've seen by the UK economy since last April. And that, of course, was when the Brexit destocking effect came in, and a lot of producers simply stopped producing because they wanted to run down their excess inventories. So at the moment, and I think if you're looking around sort of the major economies and where might we see a near-term cut in interest rates, it's certainly not a done deal that we will see the Bank of England cutting the end of this month, but it does appear that pressures are starting to mount. And if we see some soft inflation numbers for December, and they're due out on Wednesday as well, then the current background, we've got a 7-2 vote at the moment, at least at the last meeting, in terms of keeping policy on hold. We may see that split start to widen a bit, and possibly even enough to see a rate cut.
Well, that's interesting about a rate cut out of the UK. I mean, a theme of 2019 very arguably could have been central bank rate cuts. Are we going to have the same theme for 2020? And if the Bank of England starts joining in, I mean, what do you think?
Well, I think at this time, my gut feel at the moment is that it's unlikely that the Bank of England will cut this month. But it's got to be said, I was quite surprised by the dovishness, particularly of the governor's comments last week. I mean, the reason for sort of hanging your hat on the idea that interest rates in the UK are going nowhere in a hurry is simply, part Brexit, because at the end of the day, yes, we'll be leaving the European Union at the end of January. But as we've talked about before, the key trade negotiations have still got to be sorted out, and that will be crucial to how the UK economy performs over coming years. So that in itself is reason for supposing that they won't want to do anything at this stage. However, it's been the governor who's been plugging this idea that there should be some kind of bounce in confidence, consumer and business confidence once the election's out of the way. But suddenly he seems to have sort of backtracked a bit on that. Now the bank has its own agents dotted around the UK who send in reports about how their little part of the UK economy is performing, and perhaps they've got information which as yet we simply don't have access to, and the economy is doing worse than the bank expected. So I say my gut feel is probably no cut in interest rates in the UK for January, but don't rule it out. But there is an increasing chance we'll see something by the end of the first quarter, unless we do see some kind of pickup in first quarter economic activity. I think for the ECB at this stage, well, the talk from Lagarde and co is that things are looking a little bit better than they were before. So given that, I think the attitude next week when we get to the ECB meeting is that, well, look, there's no point in us changing interest rates. A number of the council meeting are unhappy with the looseness of policy at the moment, and the data we've had in since we last moved, well, it's if anything, it's a little bit better than perhaps we expected. So I think ECB is pretty well done that they'll be on hold for some time yet.
What do you think the vague, most marginal bias is for the ECB? I can say for the Fed, largely because of this low average hourly earnings result. I believe that the long-term marginal bias is toward another rate cut for the Fed. How would you describe the ECB, and also throw again the Bank of England in?
Well, if ECB, I suppose you've got to say their bias. They don't really tend to come out with a bias in the same way that the Fed does. But the ECB's attitude at the moment is kind of summed up, I guess, in its economic risks. So how it assesses risk to its own economic forecast. And as of the last meeting, they were still seen to be on the downside. So in that context, you've got to see if they're going to move, then it's more likely we see, well, not necessarily cutting interest rates, perhaps an increasing of the amount of monthly net asset purchase speeches that they make, but certainly it would appear to be towards some kind of loosening. As far as the Bank of England is concerned, of course, well, for umpteen months now, we've been reminding folks that the bank actually has a tightening bias under its central case scenario. And its central case scenario, as of the last couple of meetings, was that the UK would leave the European Union. It would agree a trade deal with the rest of the European Union, as a result of which we'd see a boost to economic activity, which, given the tightness of the labour market, etc., would force it to raise interest rates in due course. But now, in the light of recent comments, I mean, it wouldn't surprise me at all if any kind of hint of that sort of bias is dropped out of their communique, at least once we get to the end of this month. And I guess on that basis, it's a neutral, perhaps even to a slight easier bias. But it's got to be said, I mean, financial markets never believed this idea that the bank would be about to tighten at any point in the foreseeable future anyway. And they've always believed that if interest rates in the UK were going to move, then it'd be downward.
Well, this is a green light for the financial markets, isn't it? This slightly marginal emphasis on the possibility of loosening. That's all very favorable for stock markets.
I think it is at the moment, just in the way these stock markets are going. I mean, you start thinking towards the back end of last year, well, it's a heck of a good year they had last year. Surely there's going to be perhaps scope for a little bit of a pullback early on. Although I suppose we're just a few days into 2020, but what they've had so far, I suppose the news has been, reasonably good. You can even have, the problems out in Iran, and, the knee-jerk reaction to that was very much a knee-jerk reaction. You'd hardly know anything's happened at the moment. And that, of course, is always the danger, because political tensions out there are still severe. There's an awful lot going on at the moment. So it could well be that where the nasty surprise is going to come from. But I think you're right. At the moment, in terms of momentum, investors, for whatever reason, seem to be quietly confident about what's going to happen, at least first half of 2020 globally. Everyone seems to be talking up the global economy now, and really on the basis, I suspect, of not a great deal. I mean, these PMIs perhaps a little bit better than they used to be, but nothing to write home about. And if we look at Europe, the likes of Germany and the orders data there, even though we had a good bounce in industrial production in the November figures for Germany, the orders figures are still clearly trending south.
Well, it's like you said, Europe is starting perhaps to bottom. And I think that's what the PMIs are showing. The worst may be over. Who knows how the pace of recovery might be. But that would seem. I mean, you were talking about talking up the global economy. I guess it's the trend, or is it a pivot? I'm not sure it's strong enough to be a pivot, but like you say, the worst may be over.
Well, let's hope so. And I think on that suitably optimistic note, and all the more optimistic the better, since it's absolutely chucking it down with rain over here and half a hurricane blowing at the moment. Let's wrap it up here then. Next week sees the start of the 2020 central bank season, as we mentioned, with announcements due from Bank of Japan, Bank of Canada and the ECB ahead of the following week's Fed and Bank of England statements. It will certainly be interesting to hear what they think about recent developments at home and abroad. Meantime, from Mark and myself, thanks as always for tuning in. Remember to keep an eye on Econoday's global economic calendar, and we'll be back next week. Bye for now.